So welcome everyone. My name's Tom Mitchell and I'm with Cambridge Associates. The only thing noteworthy about that here today is that I'm not actually based in our Boston office, which is, I always think is ironic when I get to come to Boston and very much enjoy being here with this group. And we've been members of the Intentional Endowment Network since it started 3 years ago, and are really excited for this engagement today around community impact investing. And so as Barbara laid out a lot of the big questions that a lot of you in the room have, as I look around, I'm amazed at the folks that I do recognize and know, and just want to tell you, those of you that feel you're learning or at the other end of the spectrum, you have a lot of great resources here at your tables. So take full advantage of our time together today to really engage with those around you. So before I introduce Elyse and Barbara,
Deborah.
Sorry.
Right?
Who I just met. And there's Barbara.
Each other for years.
There's Barbara. There's Deborah. As I introduce them, because they bring incredible, really deep knowledge about place-based community impact investing in some similar and different forms, and we'll learn about that very quickly here. But at a high level, all investments have impact. So whether those impacts are positive or negative is something that, as investors, you really need to assess and understand. And so I think from impact investing and sustainable investing or community investing, all the different definitions that people assign to this type of work, a big key is what's the intention of the investor? And they really want to know, what do they own and why? And so with that, I hope that we can zero in on some very focused parts of community impact investing, which is where Deborah and Elyse and their organizations really both started here in Boston. So Elyse at Boston Community Capital, which started in 1985, as I understand, and has since put over $1 billion to work in communities, both here in Boston, but as I see, it's also certainly scaled beyond just Massachusetts to multiple other states. So as I flew up from Washington, D.C. today, I know you've done work there. And then where Deborah started the Boston Impact Initiative in 2013, has still been largely focused in Boston and Eastern Massachusetts. And I think what's interesting is both of them have looked at where are people in our communities, where do they need access to capital, resources, and things that I would suspect a lot of us benefit from, whether we realize that or just take for granted in our daily lives. How do we bring these assets, how do we raise the asset base of a community, give people access to information and financial capital, and plug them in to the economy in a way that will be virtuous for them, or help them try to change dynamics of the economy that aren't working for them. So maybe without further ado, let me turn it over to Elyse to start. And can you start by telling us, what do you think is community impact investing in this broad spectrum of where everyone's looking? And tell us more about your journey since 1985.
Sure. Well, thanks, Tom, very much. And it's terrific to be back here at the Boston Foundation, where I seem to arrive on a regular basis, and also to have all of you in the room, both old friends and new, which I think is really also terrific, because it really speaks to how much this field has been expanding over time. So I am CEO of Boston Community Capital, which, despite our name, actually functions in most of the 50 states. And we've been around now for better than 30 years. We've crossed the $1.4 billion mark in terms of our investing, and we have about a half dozen different business lines. So let me talk to you a little bit about our approach to this and how we think of community investing, which, as you'll discover, is really quite different from the way that Deborah thinks about it. And there is a real range here, which I think means that there are approaches and products and strategies available for lots of different kinds of organizations. So we function primarily as a mission-driven organization. Our mission, which really hasn't changed in our entire now 30-year-plus history, is to help build healthy communities where low-income people live and work. And what you'll notice about that mission is it doesn't say a word about money, and it doesn't say a word about investment. And it's a mission that has been broad enough and specific enough to allow us to build out a set of business lines. And we build those out in ways that are both sustainable from an organizational perspective, but also that provide a market level of return for investors and lenders into us. So let me talk about that and unpack that a little bit. There are three broad areas in which we function. One is our SUN initiative. SUN stands for Stabilizing Urban Neighborhoods, and it is, I am sad to say, still the first, the only foreclosure relief initiative in the country that actually keeps people in their homes with reduced new 30-year fixed-rate mortgages that they can afford. We also have a very large solar project. We call it C, for Solar Energy Advantage between sun and sea. I say as soon as we get to earth and water, I'm going to retire. But we're going forward in that. And we also have a little for-profit subsidiary called WeGoWise, which is really focused on utility benchmarking. So that whole part of our organization is really focused on assuring that low-income communities can achieve access to alternative energy and more affordable energy. And then the final thing we do, which in some ways is our broadest piece, is our loan fund. And that has a wonderful long history investing in the arts, in healthcare, in schools, in all kinds of housing, in community facilities. And so it really goes out and does transactions all across the country with partners on the ground and others. We are often what I describe as the point to an investment wedge, meaning we're out there putting together the deal, really creating a whole capital structure that includes not just our debt, but potentially equity, money from our money center banks, from our local banks, foundation money, all kinds of different capital to come in and make these things worthwhile. But what I want to talk about for a second is the kind of level of return that we find. Because this notion that you have to choose between impact investing or community investing and a market rate of return, I really think is a myth. So let me talk first about our loan fund. If you compare it to other fixed income investments, because that's what it is, it really is at or above market. We pay somewhere between 3 and 4% for loans of 5 to 7 years, roughly. Now, someone will say, oh yes, but that's not a risk-adjusted rate of return. Well, I just want to say, on our loan fund side, we have put out better than $800 million over the course of 30 years, and we actually have one of those classic hockey stick looking return growth things, because lots and lots of that has been more recently, and we have never lost a dime of anybody's money. So I guess you can say that it's riskier than a treasury. It also pays better than a treasury, but you know, I'll put our record up against any money center bank out there. We are also over-reserved. Now, we're over-reserved because I like to sleep at night. We have lots of conversations with our auditors about really shouldn't we drive down our reserves, and we say no, because we want to be dead sure that not just in the past, but going forward, we get to continue to say, you put your money in for 5 years or 7 years, whatever it is, you get a return of between 3 and 4%, and you're not going to have any more issue with respect to the risk of that return than you would if you were investing in publicly traded bonds at the highest level. So that's one thing to think about in terms of market. A second thing to think about, I think about our solar work. Now, lots of the players in this room are non-tax-paying entities, and so some of this doesn't work as well. But if you are a tax-paying entity, you can come into our solar deals and achieve an after-tax return of somewhere between 8 and 12%. You know, that's kind of good, and it's totally a market rate return. So again, it's a way of really saying we want to participate in assuring that low-income populations and communities can participate in alternative energy sources and get their energy from the sun and from wind, and at the same time achieve a level of return that's really identical, entirely identical, sometimes higher than other investors who are really out there on the energy side in larger kinds of deals. And then on our foreclosure work, we have now actually moved along to a $100 million bond, and so this is a bit of a tease because we're not actually looking for money in that entity anymore. But we had been paying 4.25% on that for money out to 5 years. And again, it's the sort of thing where nobody has lost a dime in that, and we've been around now for a long time. So I guess the message I would choose to leave you with is, from our perspective, community impact investing is really about the strength of the organization in which you invest, the kinds of balance sheet that organization has, the kinds of work the organization does, and then really looking for a market rate level of return.
Great. Now, Deborah, having started, almost, I guess, 3 decades after, but looking at similar challenges that I think you probably looked at in Boston those years, tell us what's distinct, what you're doing with Boston Impact Initiative, how you think about what's really challenging for communities and what you're trying to solve.
Right. So first of all, I want to say BCC has paved the way for many of us, and I'm a personal investor in BCC. BII, my organization, Boston Impact Initiative, is a co-investor. The reason I started Boston Impact Initiative, we're a tiny little $10 million integrated capital fund, which I'll say more about, but it's because I was looking around at all of the anchor institutions in Boston whose capital was leaving our community. And I was meeting, investment professionals, investment committee members, boards who are saying, there's no way I can invest in my own backyard. I was like, you don't think you can invest in your own backyard? Okay, so maybe you've got some money with BCC, where's the rest of it going? Let me see if I can demonstrate that there is a way to model a portfolio of investing integrated capital for integrated returns in your own backyard. And that was the rationale behind starting Boston Impact Initiative. And so we know that our $10 million fund is not meant to scale to $100 million. What we want to do is get anchor institutions, community foundations, universities, and hospitals to put some of that money that's leaving to Wall Street, not the whole thing, but bring it right back home. So that's the intent of what we're trying to demonstrate. What I want to say about community investing, and we talk about, here we go, the impacting the endowment dollars that have maybe more leverage in them than anything to have an effect on our mission back home. So that's part of what we want to invite folks to think about. And the thing that I also want to point out, I'll use Boston statistics, right? So many of you who are from here may know the statistic that came out 4 years ago, but it got popularized in January by the Boston Globe Spotlight series, right? Which is that we are the #1 most unequal city by income in the country. Right? So a white family in Boston has a median net worth of $247,000, and a black household has a median net worth of $8. Okay. So now if you're a black entrepreneur trying to start a business, it takes $30,000 of bootstrapping, you've got no personal savings, no collateral available, no credit history, and is that, okay, all right. And you may not have the ability to start that business, and it becomes very, very difficult to build any kind of wealth. So the wealth disparity here is extraordinary. It's heading in that direction everywhere. So black households will have median net worth of 0 by 2053, Latino households of 0 by 2073, and we're going to be a majority minority country in 2044. So while I recognize it's provocative, we are headed toward economic apartheid in this country. So now what is an institution's responsibility in its place around inequality? That's the question that we want to invite folks to think about. And where did that institution's wealth come from? This is not about shaming. It's about recognizing that the economic system that we're in, that wealthy alumni have benefited from, is an extractive economic system that has racial bias built into it. So then coming back to what is the responsibility of an endowment in a community to address the disparity in its community? That's the invitation. So here's how we think about it, and the invitation I have for all of you. We talk about impact investing as triple bottom line, people, planet, and profit, and yet we keep setting the profit side separately from the people and the planet piece. So we try to think about integrated returns, and instead of people, planet, and profit, we talk about economic justice, community resilience for planet, and enterprise health. So instead of profit, it's like, how healthy and resilient is the enterprise we're investing in? We want it to stick around. How much economic justice can we create for people? Can we close the wealth divide? Can we close the income divide? And yes, we care about ecological stewardship, but more than that, how resilient is this community? Now think about those returns as an equalizer. Right? And so mostly we have the financial return at the top and the people and planet one down below and a negative. Then we do negative screens, we get to neutral on people and planet. So what would happen if with our portfolio and thinking about community investing, we said, okay, so here's my finance, here's my people, economic justice, here's my ecological responsibility and resilience. So how do I choose, like I would with any asset, an integrated return, where on some I might lower the financial a little bit, raise the people, raise the planet. I might, in the case of BCC, fixed income, I might get across the board. That's rare. We want to be at the top of everything. So how do we just think about it as an integrated return? And that's the type of approach that we take with our investing. So
I know I've got a question for each of you, then I want to open it up to others here in the audience to speak to you. But it seems to me, to make one observation that, the work that each of you are doing is critical, and you're going into places and working with people who are otherwise deemed by the broader Wall Street, if you will, we just call it institutional capital markets, as being almost, for for whatever reason, they're overlooked or they're too costly to work with. Maybe it's inefficient in a big banking structure to go and do that. So that's clearly work that each of you have been tackling and finding a way to prove that it can be by digging in efficient and scalable. So at this time where we are in perhaps late in an economic cycle, there's a fervor around sustainability and impact, and you see Wall Street moving. Can you comment on what you think are the opportunities that people should be aware of as there perhaps is more scale in financial services, and also the risks or the things that concern you as you think about what's happening as more people are coming to the table to think about impact investing and positively driving positive change in communities?
Sure. So I guess the first thing that I would say is I would describe just Wall Street writ large, if you will, approach to this not so much as maybe those folks are difficult to invest in. I actually think it's a little worse than that. I think that a whole lot of what we have seen over the last couple of decades is an attempt to drain equity out of the neighborhoods, right? It's not just sort of neutral or they're too hard. It really is much more about, geez, these are the folks that we can get 24% from on a car loan, right? Geez, if we put some products out here on the mortgage side, and we manage to privatize the return and socialize the risk, right, which is everybody's goal, then we can actually get all these mortgages out, and we don't really much care what happens to the folks in those homes or what happens to those neighbors. Isn't that a government problem, right? So I actually think there's been a much more assertive approach by large-scale capital with respect to the neighborhoods. And partly what we think about that is we think that you can't just rely on philanthropic capital, right? You can't just rely on government capital, certainly not today. Those numbers are dropping. And you really have to figure out a way to pull in business capital, all the rest of the capital that everybody else relies on. And so that's why, and we often have civil but vigorous discussions on this question of what return really looks like, right? And how it is that you attract capital that sort of says, listen, I'd love to do this, but after all, I have to do something here. And so, that's kind of the core of this, right? It really is an issue in some respects of helping capital understand that it in fact can match return, but there's got to be a shift in the way that we think about neighborhoods, right? They are not a place from which we want to drain out equity, because draining out equity gets us exactly to the numbers that you were describing with respect to family net worth, right? And that in the long run is not sustainable. So I guess what I would say is, every time we've now been through down cycles and up cycles and, whatever, and each time it happens, I spend lots and lots of time worrying about, is this the one where our product isn't needed or cash doesn't come in or whatever, and it never happens. It's pretty interesting, right? Because the truth of the matter is, low-income communities are completely integrated into economic cycles, but their needs remain, whether the cycle's in an upstage or a downstage, right? The critical issue is to be flexible enough in terms of the capital that you provide and to be able to work with folks sufficiently that you can get through the bad part of the cycle. And so in that respect, sometimes the work that organizations like ours do is actually safer than being out in a bigger, more regulated institution that has to take more immediate action when things go bad. One of the reasons that we've been able to work with folks and actually not lose anybody's money over such a long period of time is because we can actually adjust what we do. And so if somebody gets into trouble in the short term, we don't say, okay, get out of there, we're going to sell for 20 cents on the dollar. What we say is, let us figure out how to work with you so that we really build this over time. When you talk about the risk, I think the biggest risk that we have is this ever-increasing income inequality. People don't starve silently. And I think that piece is getting to be more important as we go on.
Yeah, I mean, part of it is we have a financial system that is designed around anonymous and opaque and many intermediated transactions. If we have an investment system built around relationships, which you can do in community investing, which you can do in place-based investing, the equation changes. So when the perceived risk about investing in some of these communities happens from that abstract place. So an example would be, I'll give you two examples from our portfolio that I think help illustrate this. One would be, we invested in a company called Sunwealth that is putting solar panels on 4 black churches in Dorchester, Jamaica Plain, and Roxbury. The underlying credit risk of the black churches is perceived as very high. That's if you don't have a relationship with them, if you don't know who they are, if you don't know that they've been operating for 20 years, 30 years, and that they have a successful congregation and they're in conversation about how to support this effort, right? And we're getting a 6.5% return on that investment. Another example is investing in a company called Wash Cycle. It comes out of Philadelphia. We help bring it to Boston. It's small batch laundry that is in very high efficiency washers, so good for the planet. Delivered by bicycle by returning citizens and underemployed populations. They won a $1.2 million hotel contract. We're making a investment, the debt investment at 6%, an preferred equity investment. We might make 15 to 20% on that if all goes well. Think about what happens if you are an endowment and you decide to, you're an institution, you make an investment in Wash Cycle, and then you use your procurement capacity to ensure that Wash Cycle has business. You're in relationship with your investments. So there are ways to de-risk this story of perceived risk about neighborhoods and populations that the financial system writ large is not going to be able to handle. So the idea is when we go into community investing and we come into relationship with the people and the enterprises in our places, we can completely transform that risk story.
Great. Well, with that, I know that we rushed to get started. I want to make sure there's plenty of time for questions. Let me open it up to all of you in the audience. Let's see. Yes.
I'm always intrigued, as I said through these conversations, about these wonderful investments that pay off and do so well. The question I've got, and I was asked at the table, is can you give me both examples of some investments that you looked at, it was socially worthwhile, but didn't make, or wish you hadn't made, where it went bad?
Sure. I was trying to think about. So we have one. It's going to be nameless for all the obvious reasons. It's a school that is focusing on education in communities of color, and they are primarily supported by philanthropy. And they've had a really, really, really hard time paying their mortgage and paying their debt back. And so we have now been working with them for, well, I'm going to say 10 years. It could be 15 years, right? And for a loan that should have been much shorter than that, we have helped them get additional philanthropy in order to drive down their costs. We have readjusted their time to payment over time to assure that they can actually continue to pay. We've worked with them in all kinds of ways, but we haven't written off the loan, and nobody's going to lose any money off that loan because we've also 100% reserved against it. So do I wish we hadn't done it? I don't know. I'm of two minds about it, right? On the one hand, it's a fabulous return in terms of the kids who were there and what the community gets. On the other hand, it takes a gigantic amount of time to sort out. So hindsight's a wonderful thing, and Monday morning quarterbacking's is even better. So from this vantage point, maybe I wouldn't have made the loan, but I'm not so sure it was a bad one to make in terms of the return that it provides for the kids and their families.
So similarly, and I want to go back to this, which is we have an investment we've made in a company that we love. It's a worker-owned cooperative, and it's zero waste. It employs everyone you wish for, and we've had to move all along the spectrum. It's just what Elyse said. Like when you have a relationship-based investment strategy, there are things that you're going to do to make sure a company doesn't fail. In addition to also being over-reserved compared to conventional finance. I've gone out and made sure I could solicit some grants for that organization when it had a cash crunch, right? And gone out and found some different types of equity capital, of debt capital that would help them at this moment in time. And so one of the things is when we can activate the full spectrum of capital, either our fund directly or through partnerships. I mean, we went into an investment where we said, we can only do a little bit. Boston Community Capital, will you come and do the big chunk of it? When we are in a place, we can activate the entire ecosystem of capital, including philanthropy if needed, and help get some of these companies out of the hole. And I think that's a big shift as opposed to I've got a venture fund and that's what I'm doing, period.
Thank you.
Other questions? Sorry, get my exercise to me.
Thank you so much. Hi, Sudhar Yao from Social Finance. I don't know if you've had an opportunity to speak a bit more about opportunity zones. I'm sure that within your organizations you're all thinking about it. I guess it's more directed to investors, but of course I'd be very interested to hear what CA's thoughts are as well on this opportunity.
Sure. So we have taken a careful look at that. In fact, right from the very beginning. And so do folks know what opportunity zones are? Maybe let me spend 10 seconds just sort of explaining what this is. It's a piece of legislation that got included, I think, in the tax bill. It wasn't exactly baked, and nobody really expected it to go in. And so it's got, I'm not sure, and nobody's quite sure it works. But the idea of this is that each of the states was going to set out, I think, 25% of their lower income areas as these things called opportunity zones, and then funds could develop that would invest into those zones. And for people who put money into the funds, they would have cover for their capital gains. And the question of how much of a reduction in capital gains tax you got depended on how long the money was in for. And so I think it's 10 years. If you leave the money in for an entire 10-year period, whatever capital gain you had on the money that you had earned in the first place goes away. And in addition, you have some return from whatever the investment is. The questions, I think, are many, including that the regulations aren't in place yet. It's not clear to me exactly what kind of scale is available in the neighborhoods that have now been established as opportunity zones. And the thing that's most not clear to me is whether the level of subsidy is sufficient to really support the kind of return that investors are looking for. So we're watching it. I am more skeptical about this particular approach than I was, say, about new market tax credits, which has been an extraordinarily successful undertaking. When it came out, we said, it's the Wild West, let's go do that. And actually we used it to bring lots and lots of fee dollars into the organization to support new undertakings. This one really remains to be seen. My initial take on it is that the subsidy is not sufficient to support it.
Yeah, hi, Jackie Vanderbrug, Bank of America. Tom, I appreciated your initial comment, all investments have impact, and those of us in the impact space for a while would give huge credit to community investors, right, that were in some sense the original impact investors, or at least that's how they're said sometimes. Curious how you both would consider this. Now we're talking about community impact investing. Do you distinguish that from traditional community investing? And where is that overlap, or where is it that traditional community investors have opportunity to sort of meet you in the middle, and what does that look like?
So language changes, right? When we started doing this 30 years ago, nobody talked about impact investing. We all talked about community investing. I think it's the same thing, right? I mean, the real issue is in terms of who the investors are and in terms of who the organizations are, where are they on the return spectrum, both from a financial return and a social return perspective? As I've been sort of saying, you know, our goal has really been to achieve all of that. Other folks have different goals about it, but I don't really think there's much difference. I think the community investment community has been slow to pick up the impact investment label, but I actually think it's the same thing.
And language is all over the place these days, right? Because in my world, community investors now are non-accredited investors who are coming to participate in. There aren't as many products out there for them, but both of ours are. Where non-accredited folks have something to say, whether it's through crowdfunding or some of these kinds of more democratic investment opportunities to start redirecting local capital as well.
I have time for one more, maybe.
Okay. Oh,
Is there anyone else? Okay.
Yeah, Paul.
Hi there, Paul Herman from Hip Investor. I'd be curious what either donors or investors are asking for in terms of impact reporting and how granular, quantitative, or storytelling oriented that is, or the mix, and if that's feeding into sustainable development goals yet.
So in terms of on the measurement side, we actually feel very strongly, I mean, measurement can get in the way, but it's really critical. And so because our fund is so focused on closing the racial wealth divide, it actually gets easy to measure. I think the problem with measurement is when it's too abstract. It's like a little bit of everything. So when you're really clear, like I have a friend who is investing for soil health, so she can measure soil health. So when you're investing to close the racial wealth divide, you can measure compensation ratios between highest and lowest paid worker. How much compensation are women of color taking home? You can look at diversity and inclusion on board staff. So there's 35 questions that we measure. And I don't know if it's actually coming as much from donor and investor demand as it is from us trying to demonstrate. I want to make sure that our fund is doing that and not just
creating financial return. I want financial return, of course, and I want to make sure on that equalizer model that we're hitting the objectives that we say we're hitting on that return. And so I actually think measurement is critical, but we need to go a little bit into diving deeper into what the actual mission is and measure that specific mission and not the whole kitchen sink.
And well, I would say that I agree. It's critical. It's evolving. I think you get very different ways of measuring private market investments versus public market investments, but it is both quantitative and qualitative, Paul. I think you know this well, I'm sure, that are important. That we find when we talk to our clients, they want to see quantitative measures and they want us to keep working on doing that, but the stories resonate, particularly with philanthropies that are saying, this is how we see the world and this is what we want, this is the change we want to affect. Those anecdotes are critical for that too.